Before we dive into today's content, let's run through some quick housekeeping items. RiskOut will be sharing all of the webinar resources, including the slides, handouts, and today's recording in a follow-up email tomorrow, so keep an eye on your inbox. We also want these sessions to be as valuable for you as possible, so if you have any questions that might come up throughout today's session, we encourage you to ask them through the questions section of the GoToWebinar control panel on the right side of your screen. We will also be running a few webinar polls throughout today's session to better understand our audience, so your participation is greatly appreciated. For those of you that are joining us for the first time, welcome. RiskOut is a team of former bankers, regulators, and industry experts that have joined together to help community financial institutions unlock complex markets to increase deposits from within their own backyards. Through both software and services, RiskOut reduces the time, effort, and uncertainty around expanding into new markets so you can increase your footprint without having to open new branches. If you're interested in learning more, visit riskout.com to get in touch. Next month, we will be hosting an advisory workshop. Our team of experts will spend 90 minutes working through hands-on exercises to help financial institutions that have or are interested in starting a FinTech partnership program. All of our attendees will receive their own policy template, a FinTech-focused risk assessment, and an ROI calculator to determine how much business your program needs in order to be profitable. Whether you have a new program or one that's been running for years, this session will help you feel confident around partnering with FinTechs. Visit riskout.com today to reserve your seat. Today's presenter joins us from Harris Beach Attorneys at Law, a firm that provides services to financial institutions of all sizes, from the largest national and international banks to local banks and credit unions. Their attorneys handle matters before state and federal agencies, including but not limited to the FDIC, NCUA, OCC, FinCEN, and OFAC. If you're interested in learning more, visit them at harrisbeach.com. Today's session will be led by Constantine Lizas, a partner at the law firm Harris Beach. Constantine joined the firm's Washington, D.C. office after leaving the FDIC's enforcement section as an acting supervisory counsel in the FDIC's lead BSA AMA counsel. At the FDIC, he advised the interagency team that began drafting new rules pursuant to the Anti-Money Laundering Act of 2020. He also served as a federal prosecutor in the Department of Justice's Money Laundering and Asset Recovery section. Today, he assists financial institutions with examination matters, enforcement actions, government investigations, and compliance issues. We are very excited to have Constantine joining us here today. And without further ado, Constantine, I'll go ahead and pass it over to you to dive into today's webinar content. Take it away.
Hi, everyone. I'm Constantine Lizas, and I'm a partner at Harris Beach's financial services team. I'd like to welcome you to today's program concerning the CTA's final beneficial ownership information rule. The program focuses on the needs of bank compliance personnel. We also touch on some expected requirements concerning the soon-to-be finalized access rule, which will cover how financial institutions will access the FinCEN beneficial ownership information database. If you have any more in-depth questions about determining beneficial ownership, the final beneficial ownership rules, various exemptions, or issues with new policies and procedures, please feel free to contact me directly after the program. I also want to take this opportunity to thank the great team at RiskOut for putting this program together. They have been great to work with, and I really appreciate the ability to collaborate with them. Before we proceed, a couple legal housekeeping items. Please feel free to ask questions throughout the chat function. We will keep time available to answer questions. We'll answer as many questions as possible, either during the webinar or at the end. And finally, please note that this program is for informational purposes only and does not constitute legal advice. Should you need legal counsel, please feel free to contact me directly. And Ethan, do you want to ask the poll question?
Absolutely. That will take us into our first poll question. Thank you, Constantine. You should see this coming up on your screen right now. And we would love for you all to take a quick moment to give us some feedback here. This asks, how are you tracking your beneficial owners today? You could select any of the following options, those being not monitoring at all, which we hope is not the case at your institution. Maybe you're using paper files or an Excel or Google spreadsheet, maybe an automated software system, or heck, maybe you're just not sure. We would love to get your responses here. Go ahead and answer the question on your screen, and we'll share that out with everyone that's attending here momentarily. Excellent. Thank you all. Give it one more second here before we close out. All righty. Okay. So it looks like you should see the results coming up on your screen now. It looks like 41%, the most common response here today, is that our audience is using paper files to track their beneficial owners today. Fortunately, it's not followed too far behind by those automated software systems. And then roughly 21% of our audience today is either using an Excel sheet or they're just not sure what they're doing to monitor today. Constantine, how does this stack up to what you were expecting to see?
You know, I think I'm actually pretty impressed with the number of people that are using an automated system. With that being said, I probably expected to see a little bit more use of Excel and a little less use of paper files. But those are the initial thoughts that jump out at me.
Agreed. Well, thank you all for your responses. Again, we'll have a couple more poll questions coming up, but for now, I'll let Constantine dive into our first section on setting the stage for us.
All right, the current beneficial ownership information rule. Banks have to identify beneficial owners at the time a new account is opened. The current rule is codified at 31 CFR 1010.230. The definition of a beneficial owner: each individual who owns 25% or more, and a control person. The control person is defined as an individual with significant responsibility to control, manage, or direct the legal entity customer. It could also be an executive or senior manager, i.e. a CEO, CFO, and an LLC, a managing member, things like that. Could also be any other individual who regularly performs similar functions. The current rule is sometimes called the rule of 5. That is, no more than 5 individuals need to be listed as beneficial owners. As part of the rule of 5, it also goes without saying that at least one individual needs to be identified as a beneficial owner. And under the current rule, that would at minimum have to be the control person. And when you take a look at our example on the right side of the screen, you see that neither John Smith nor Paul Simon have to identify themselves as beneficial owners of ATEC. John Smith owns 95% of ACME, and Paul Simon owns 5%. And then ACME itself owns 25% of ATEC. Thus, John Smith owns just under 24% of ATEC, and Paul Simon owns just over 1% of ATEC. And under the current rule, both are under the 25% threshold. Just so that we don't get anyone confused here, under the new rule too, it would be the same thing. So let's move on to the beneficial ownership information since 2018. The beneficial ownership information and CDD rules are just 5 years old. Initially, when they first came out, I think they were treated more as check the box exercises. And a little bit of historical context, I think, is in store here. The rules came out in 2018. At that point, the rule, as everybody knows, was only a part of the Federal Banking Agency program rule in terms of, they were in the internal controls. And also as part of, and they were a separate pillar or component of the FinCEN program rule. But both of them incorporated beneficial ownership information. So how they developed? Well, they're now both foundational. Regulators are focusing on the risk profile and want to see that the risk profile is meaningfully developed. OFAC screening is also implicitly a part of CDD and beneficial ownership information. It's part of knowing who your customers are and understanding your customers. It's also becoming knowing your customer's customer, which is now a huge issue in the OFAC world. Emphasis on OFAC screening, as you can imagine, is here to stay, or at least until there's rapprochement with Russia. So moving on to the next slide, let's talk about enforcement for a few minutes. The CDD and beneficial ownership information rules came out in May of 2018. Less than 2 years later, in early 2020, the pandemic came. So we didn't see our first major CDD and beneficial ownership information enforcement action until spring of 2022. One of the first cases was against USAA Bank. There's a lot in that enforcement action, and I recommend all chief risk officers, compliance officers, and BSA officers to read about the case if you haven't already done so. Today, I'm only focusing on CDD and beneficial ownership information. In the USAA enforcement action, FinCEN and the OCC found that USAA's CDD was insufficient to develop the customer risk profile. Here we really see regulators making CDD foundational. They signal that if you do not have an appropriate risk profile, you cannot accurately monitor your customer. Also, don't forget the benefits of robust CDD and appropriate and meaningful customer risk profile is that they allow financial institutions to implement risk-based systems and allocate resources more efficiently, which is a good thing for financial institutions. The OCC in the USAA case also found that CDD was insufficient to support non-SAR decisions. Regulators essentially said that in 20% of all cases, USAA could not make non-SAR decisions because it didn't know its customers well enough to make that call. And so, again, to focus on the point on how important customer due diligence has become. Let's take a quick look at BitREx and enforcement action by FinCEN and OFAC. In addition to failing to maintain an effective BSA AML program, the regulators also found over 116,000 apparent sanctions violations and inadequate screening. So the takeaway here is that you can't do adequate screening without sound CDD and beneficial ownership information. Regulators also found that IP addresses associated with sanctioned countries were accessing the platform. Here, the issue is that understanding how your customers access the platform will give financial institutions information on who the customers are and where they are located. One other thing that I'll point out that regulators saw was that BitREx had lacked blockchain tracing software. While this isn't strictly a beneficial ownership information issue, it is a good reminder that financial institutions need to understand who their customers are and with whom their customers are transacting. Finally, let's talk about Coinbase. Coinbase was a settlement with the New York Department of Financial Services. In that case, regulators stated that CIP must be more than an uploaded copy of a photo identification. Financial institutions must identify clearly inaccurate information. In that case, regulators were telling us that financial institutions need to know who their customers are. Because CDD is foundational, look for regulators to get tougher with verifying beneficial ownership information. Another thing that New York regulators had identified was that the customer risk ratings were not informed. Going forward, financial institutions will have to make sure that they understand the beneficial owners to understand the risk. Finally, financial institutions must monitor how and from where customers access online programs, online platforms. This is a bit of a repeat from BitREx, but again, it just goes to show that financial institutions will need to understand this issue to ensure access is consistent with beneficial ownership information. This case and BitREx are good reminders that how customers access the platform is and will be an issue, and that financial institutions will run enforcement risks if they do not monitor and mitigate the online access risk. All right, let's move on to the next slide. FinCEN issued the final beneficial ownership information reporting rule implementing the CTA's requirements in September of 2022. It's codified at 31 CFR 1010.380. And just for clarity, the upcoming access rule that hasn't come out yet will be at 31 CFR 1010.950 and 955. Reporting companies will have to report beneficial ownership information directly to FinCEN. And it'll be the same in the sense that it'll be 25% or more ownership. However, in this rule, it'll be substantial control, and we'll talk more about that later. The final beneficial ownership information rule does not replace the current rule. It is additive. Beneficial ownership information reporting under the new rule begins on January 1st, 2024 for companies created in 2024. They will also have 30 days to file with FinCEN once they have been created. Reporting companies created before January 1, 2024 must file beneficial ownership information with FinCEN by January 1, 2025. So in some sense, the beneficial ownership rule will have a bit of a soft opening, mostly because for most of 2024, it'll be for entities that are created in that year until then toward the end of the year when everybody else starts to file. All right, let's move on to the next slide and let's go through some of the definitions. What are reporting companies? They are U.S. entities or foreign entities registered in the U.S. They can be corporations, LLCs, certain partnerships, etc. The key is whether the company is created by the filing of a document with the Secretary of State or similar office. Generally, that excludes trusts, partnerships, and sole proprietorships. The rule will also exclude 23 types of businesses like large operating companies. Those are companies with more than 20 employees and $5 million in revenue. It will also exclude banks and companies listed on a stock exchange. All right, back to you, Ethan.
Excellent. That does bring us to our second poll question of the day, which should be showing up on your screen now. And that question is going to ask, how confident are you that your current customer due diligence processes incorporate full beneficial ownership? And that everyone can give one response here, kind of on a sliding scale, all the way from extremely confident down to not at all confident. Would love to get a feel for where you think your financial institution and your CDD program in particular falls in regards to beneficial ownership. Give everyone just a couple more seconds here. It looks like we've already got some really great engagement. All righty, okay. And we'll share these results out with the audience. And fortunately, it looks like we've got a pretty confident audience on the line today. So as you can see, 55%, the majority of our attendees today said that they're feeling pretty confident about their CDD process and the fact that it does account fully for beneficial ownership. 30% up there feeling extremely confident. Only 14% putting themselves at the very bottom or towards the bottom there by saying they're either not at all or just fairly confident, which is excellent. Constantine, this is a little surprising to me. I typically see people feeling a little less confident, particularly around CDD. I'm curious, does this align with what you were expecting to see today?
I agree with you. I was expecting to see a little bit less confidence, but I'm happy to see that there's such a high degree of confidence.
Absolutely, I agree. That's great. Everyone, keep up the good work. Glad that you're feeling confident. Constantine, let's go ahead and move into what our audience should expect to see with the upcoming final rule.
All right, so talking about the CTA, what must be reported to FinCEN? The reporting companies must report information about the company itself, such as the full legal name, business, street address, things like that, the beneficial owners and their information, name, date of birth, etc., and also the company applicant. At the time of formation, so for the company applicant, that'll only be something for companies that are formed after January 1 of 2024. Anything existing before then, the reporting company will not have to report the company applicant. Who are the beneficial owners? Same as before, or substantially the same as before. Individuals who own or control at least 25%. And then here's where the difference is, or exercise substantial control directly or indirectly. This is one area where the differences with the current rule are substantial. Under the new rule, it follows at least one individual with substantial control will be identified. And for companies created after January 1, 2024, the company applicant and at least one person with substantial control will be identified. Let's move to the next slide. What does ownership interest mean? In most scenarios, it means equity, stock, or a similar financial instrument. But it could also mean capital or profit interest, certain convertible instruments, etc. Now, here's the big question. Who has substantial control? Senior officers, think CEO, COO, CFO, EVP, managing member, things like that, but not the corporate secretary or treasurer. In addition, those who have substantial control are individuals who have authority to appoint or remove senior officers or a majority of the board. Could also be anyone who directs, determines, or substantially influences important decisions. And finally, it could also be individuals with substantial indirect control. Some examples of people who may have indirect control include board members, individuals with ownership or control of a majority of the voting power, think Jeff Bezos and Amazon, or individuals with control over companies that exercise substantial control over other companies. Here, think Walt Disney and Disney World's purchase of Florida land through anonymous LLCs. All right, let's move on to the next slide. With the new rule, the burden is on reporting companies to report beneficial ownership information directly to FinCEN. They must also report changes in beneficial ownership information. There will also be criminal and civil penalties for misreporting, failing to report, or failing to update information. So the obvious question is, will FinCEN penalize companies for not filing on time, or not updating? The answer is it depends. And will they, if they're going to have penalties, are they going to try to seek criminal penalties? Well, again, it depends, and it's going to be whether the acts were intentional, and if it was intentional to assist in wrongdoing, whether it's intentional misreporting, or whether other statutes are inadequate for prosecution. And so those are some of the things that regulators and prosecutors will be looking at in the future. In terms of the impact on reporting companies, there's been estimates that 25 to 40 million reporting companies will have to report beneficial ownership information to FinCEN. FinCEN has also estimated the cost to be $85 per reporting company. For very basic LLCs, that may be the case. For more complicated ownership structures, the cost is going to be significantly higher. And then, as we've said a couple times here, reporting companies will also have to report beneficial ownership information to financial institutions.
Constantine, before we leave this slide, we did have a question come in from the audience asking, is there any precedent for civil or criminal penalties surrounding the Corporate Transparency Act that our audience should know about?
No. At this moment, there's no precedent. It's just the statutory law at this point, and we just have to see where it goes. And that's going to be a complicated mix of resources, of what type of intent is behind maybe the lack of filing, the misfiling, or the lack of updating. And I really think here, with respect to beneficial ownership information, one of the things that's going to be really important is to understand what the company is doing. And so if you have a regular company that's a legitimate company and they just forget that they have bad controls, the person is not as responsible as they should be, I don't see any major liability for that individual or company. But if you have a company that's helping to layer funds in a money laundering scheme, and let's say the prosecutors can't prove that that company knew that the funds were the funds of a specified unlawful activity, and they can't prosecute for money laundering, but they could prosecute for a violation of beneficial ownership information reporting, then I think that's, in that type of situation, I think you are going to see prosecutors and regulators trying to go for a criminal penalty.
Thank you for that answer. I appreciate that context. As a reminder, if there is any other questions that y'all might have, don't forget that you can also ask those in our GoToWebinar control panel. We'll continue to ask those as we move forward. Thanks, Constantine.
All right, moving forward with how to prepare. And then CTA issues for reporting companies. The reporting companies are going to need to understand the final beneficial ownership information rule. They're going to have to prepare for initial reporting to FinCEN. They're going to have to determine who has substantial control within the company. And they're also going to have to determine who owns 25% or more and all the different exceptions. In addition, reporting companies are going to have to implement new internal controls and processes to determine who has substantial control, indirect control, and maybe most importantly, to update the beneficial ownership information on an ongoing basis. I can tell you that the updating is one of the areas that is causing a lot of concern in the industry. I mean, and by industry, I mean not just with financial institutions, but also with in the corporate world. And that is how are reporting companies going to have those internal controls to understand that every time there's a change, whether it's a change of family member or a change in a CEO, CFO, COO, things like that, that there's going to be the internal process to report to FinCEN. And so that's really one of the big issues right now. In addition, reporting companies will have to understand the different beneficial ownership information reporting to FinCEN and to FIs. They're going to need to understand that the information reported to FinCEN and financial institutions is going to be different. They're also going to need to understand the exemptions that will be slightly different as well.
Constantine, we did have another question that came in, and that asked, how will the reporting of these reporting companies, how do they actually get those reports to the FIs? Are they doing that through the FI's beneficial ownership information forms?
Well, so the reporting companies will send the information to FinCEN. I mean, ultimately, there's going to be an online VPN or an online PDF that will be submitted to FinCEN, and that will go directly to FinCEN. It will not go to the financial institution. And so that's, and we'll get into that a little bit in the next few minutes, but that's where we're going to have some of the confusion here, is because the reporting companies will have to report to FinCEN. And then when they open a new account at a bank, they're going to then have to submit beneficial ownership information, which again could be slightly different and have slightly different exemptions. They'll have to report that information to the bank. And then it'll be up to the bank to contact FinCEN to confirm whether the bank has, or the bank or the financial institution has, the correct information.
Thank you, I appreciate that. I'll keep us moving here.
So financial institutions must also collect beneficial ownership information from reporting companies, and they must understand that the final beneficial ownership, and they must also understand the final beneficial ownership information rule. Financial institutions are going to have to understand that the final access rule laying out how financial institutions will access the FinCEN database has not yet been finalized. We're waiting any day now for the final access rule. The best guesses are that the final access rule will come out in September, but there's also been a lot of political lobbying and jockeying in Washington, D.C., and so we'll see if the final rule actually does, if the final access rule actually does come out in September. FinCEN calls the beneficial ownership information database the Beneficial Ownership Secure System, or BOSS. I haven't yet gotten my head around BOSS, so I continue to use the term the FinCEN database or the Beneficial Ownership Information Database. How financial institutions will collect beneficial ownership information, access the FinCEN database, use beneficial ownership information, and share that beneficial ownership information will require new policies and procedures, and maybe even new systems. Financial institutions are going to need new beneficial ownership procedures going forward before financial institutions access the FinCEN database. They're going to need to establish administrative and physical safeguards. Financial institutions will be able to share information from FinCEN within the financial institution to others located in the US. They can also share that information, they can also use that information only for the purposes of customer due diligence. Financial institutions are going to have to establish technical safeguards. The beneficial ownership information will have to be protected from cybersecurity attacks, at least as well as other bank information, and meet certain technical specifications still to be finalized. Financial institutions are also going to have to obtain and document customer consent. And so the financial institution is going to need consent from the reporting company to make a query to FinCEN. And that's also going to affect onboarding procedures. And then when they do make the query to FinCEN, they're going to have to certify in writing that the request is for the purpose of customer due diligence and that it has the consent of the reporting company. Also, if I haven't quite made it clear, let me just say that financial institutions are only going to make requests to the FinCEN database or to FinCEN for it to search the database. Financial institutions are not going to be able to search the database themselves. Finally, another procedure that financial institutions will need is training. Training is not a per se requirement, but if a financial institution does not train personnel and has issues, it's not going to get a lot of sympathy from regulators. Now let's talk about some beneficial ownership information policies going forward. There's a number of policies here, but the first is whether to access the FinCEN database. If you've heard any other talks on the beneficial ownership rule, you've heard that some commentators believe that FinCEN will not require financial institutions to use the database. However, even if not required, failure to access available information could lead to negative treatment in enforcement actions and other litigation. It's my general thought that putting your head in the proverbial sand is rarely a good strategy. Next, let's talk about when to use the FinCEN database. Financial institutions will need to determine whether to access the database for all reporting companies, just high-risk customers who are reporting companies, or maybe when there's an alert for a reporting company. And those are some of the things that need to be determined and figured out. The last is what to do when chaos comes. I'm going to cover chaos more in the next slide, but for now, let's just say this. Let's say that an FI is going to need a policy on what to do when an existing customer does not give permission to access the database. So Ethan, let's go to the next slide. So financial institutions are going to need to prepare for multiple issues. Chaos is coming. The first issue, let's say that a customer does not give, let's go back. The first issue, let's say a new customer does not give permission to search the database. Then the question will be to bank or not bank the customer. And the answer may depend on the risk profile. Another question is whether the existing customer, another issue is whether an existing customer does not give permission or gives permission to access the database. If they don't give permission, does the financial institution conduct additional customer due diligence? Does it follow SAR? Does it de-risk? These are all issues that need to be figured out. Another, the beneficial ownership information provided to the financial institution is inconsistent with the FinCEN database. The different exemptions and reporting to FinCEN are also an issue. And so we have to look at whether it's a misreporting issue, or is it a misaligned information issue, or misaligned exemptions between the current rule and the new final beneficial ownership rule. Let's take a look at a very basic scenario to see how there's going to be problems. Under the current rule, an existing customer only reported the lawyer as the control person. Under the new final beneficial ownership information rule, the reporting company reports the CEO and the COO as the beneficial owners because they have substantial control. Thus, under a fairly basic scenario, a misalignment of the beneficial ownership information between what the FI or the financial institution and FinCEN have is very likely. Let's say that you send a query to FinCEN and learn that the reporting company is not in the FinCEN database. Well, that's going to be another issue that will need to be understood and figured out. Another issue that the information is not updated in the FinCEN database, or maybe the opposite. Maybe after going into the FinCEN database, the financial institution learns that it doesn't have the most current beneficial ownership information. Finally, one of the last issues that we're going to talk about today is the frequency in accessing the database. So financial institutions will need to start to understand whether they query the database again after a negative news. Or a suspicious activity alert. Because the database can only be used for customer due diligence, financial institutions are also going to need to understand how FinCEN will differentiate between suspicious activity investigations and additional customer due diligence, also known as CDD. So these are all issues requiring new policies and procedures. All right, let's move on to the next slide.
Constantine, before we move on, we had a clarification. Did we understand correctly that financial institutions are not going to be able to search the database themselves, but is it really going to be by inquiry only?
Correct.
How will that work?
There most likely there will be a portal. It's not going to be an email, so there will be a portal where then the financial institution will go into the portal and submit a query, and then somebody from FinCEN will go ahead and then search the database. And so you already have a system that is going to be very difficult to maneuver, and it'll be made only more complicated by the fact that the financial institution will not be able to search the database. Now regulators and law enforcement and things like that, they're going to have more access to the database, but to financial institutions are only going to be able to request that FinCEN run individual queries.
Wow. Okay, that's good to know. Thank you for sharing that with us. We also had another question asking for a bank or a credit union that works with a fintech. Is it the responsibility of that financial institution to contact the fintech to verify all beneficial ownership information?
You mean, so I guess I'm not quite understanding the question in the sense of, is that meaning the beneficial ownership information of the fintech itself or of its customers?
My assumption would be of its customers.
Right. At the end of the day, if they have what is defined as an account at the financial institution, then that burden will be on the bank.
Yeah, that's my understanding as well. And just as a reminder, we are hosting a workshop next month for fintechs and fintech partnerships in particular. So if that's a topic that you'd like to dive deeper into, you can visit our website. We'll have a hands-on workshop to be able to get even deeper into the fintech specifics, even around beneficial ownership. Thank you again for asking those questions, and we'll go ahead and move on here.
Let me just say though also, third-party risk is the other huge issue at the moment. Regulators just put out new third-party risk guidance in the past few weeks. And so that is definitely something that's a concern and top of mind for the regulators. And for the purposes of this program, let me just say that banks need to understand what they do. Banks need to also understand what the third party does, and they need to all be on the same page and make sure that everybody's meeting all their BSA responsibilities. All right, so moving on to CTA issues for financial institutions. Another important note is that beneficial ownership information has a different sharing regime than suspicious activity reports or SARs. As just mentioned, financial institutions can share beneficial ownership information within the institution. They can share with directors, officers, employees, agents, or contractors who are located in the United States. They can also share with federal banking agencies, the SEC, the FTC, and self-regulatory organizations. However, financial institutions cannot share beneficial ownership information with other financial institutions. In contrast, SAR information can be shared with other financial institutions under FinCEN 314B. Also, SAR information can be shared overseas in some situations. And as we just discussed, the beneficial ownership information cannot be shared overseas. So this leads to some questions. One is, what happens if beneficial ownership information is in a SAR and the SAR is shared with another institution through 314B? The answer, we don't know yet. And that's something that FinCEN has been pondering, and we're still waiting to see what the guidance will look like. What is the takeaway here? Well, the takeaway is that financial institutions will also need policies and procedures for the sharing of beneficial ownership information. All right, let's move on to the next slide. I want to talk just briefly about the New York LLC Transparency Act. This bill is not yet signed and is waiting for the governor's signature. But if passed, New York would create a public database for limited liability companies. If passed, it would go into effect on January 1, 2025, and would apply only to LLCs in New York or foreign LLCs registered or qualified to do business in New York. The substantive terms beneficial owner, reporting company, and exempt company mirror the federal definitions. The FinCEN report filed by the LLC to FinCEN could also then just be sent to New York. So if this law goes into effect, there would be more reporting and more headaches for New York LLCs, but not a lot of additional work. Now, this framework from New York, or this proposed framework from New York, would have two major differences than the FinCEN beneficial ownership information framework. The first is that So on the screen, I think it says non-public database. Well, the FinCEN has a non-public database, but as we discussed, New York would have a public database and would end the practice of anonymous LLCs. It would also create the fact that the New York database would be public and the FinCEN one would be non-public would create confusion within the banking industry on how to use information from New York that is public and information which would be the same information from FinCEN that's non-public. The other issue here is that financial institutions obviously would not need permission from the New York LLC to access the New York database, but would still need permission to access the FinCEN database. So this law here could create more confusion in terms of protecting the information, sharing the information, things like that. Stay tuned to this developing space. Let's see if New York signs the law and whether other states will follow. California has been debating a similar law for some time. Let's also see what FinCEN has to say about its own beneficial ownership information access rule and future guidance. Back to you, Ethan.
Excellent. Thank you, Constantine. Now we have set aside a good amount of time for questions here at the end, which is excellent because we have a huge amount of those coming in. A reminder, if you have one that you'd like to ask as well, go ahead and use the questions tab of that GoToWebinar panel. And now's the time where we'll address them. Before we dive into those, we have one poll question that we'll ask you here that should be coming up on your screen. Unlike the previous poll questions that we've asked today, you can select as many or as few responses as possible, just to let us know if you would be interested in getting in touch with RiskOut or Harris Beach about any of the following topics. All right, like I mentioned, Constantine, we have gotten a huge amount of questions here that I would love to start going over, a lot of them about this database in particular. So let me get situated here. Okay, we had a question asking, you mentioned that financial institutions will have to request consent from their customers around BOI. How would you recommend they go about getting that consent from their customers?
Well, for new customers, it's going to have to go into the onboarding procedures. For existing customers, it's then going to need to be then inserted into the account relationship paperwork, which means then that it would have to be re-executed at some point going forward.
That makes sense to me. Let's see. Okay, so we had this one's a little bit of a longer question, but I want to. I think it's valuable. So it says the rule states that individuals that own 25% or more of an entity, or any individuals that have substantial control of a company, will need to be reported. So for an example where there are 4 individuals that each have a 25% share as a company, as well as 3 individuals that control the entity, such as the board members or CEO, that would mean that all 7 of those individuals would need to be reported. Is that correct?
That is correct. And so that's another example of the difference between the current rule and the new rule. So under the current rule, you would have the 4 beneficial owners and a control person. Now the control person would be just one person. Now you're in a situation where all of those with substantial control will be listed. So you're going to have now, in this case, like we said, 7 individuals. With that being said, there's no limit on how many people would can be reported. Although at some point you would think after, I don't know, 5, 10, 15 people, maybe then after that, there's not as much substantial control. But that's something to be determined at a later date.
Thank you, thank you. Okay, here's a question that asks, the current BOI rule states that the information must be obtained prior to account opening. Therefore, if an inquiry is made to FinCEN, what can we expect that turnaround time to be?
That's something we're still waiting to find out. I mean, we're not sure yet. Hopefully, we're just talking same day, maybe a couple business days.
That's good to know. I'll say I see here we have at least 5+ questions that are asking something along those lines around that turnaround time, which I think makes total sense. It's hard to know, if we can't open an account until we have certain information. Getting that information is dependent on an inquiry with FinCEN. Definitely something that we'll want to know as we get a little bit closer to that January 1st date.
Right. Let me say one other thing, though. The FinCEN database, from what I understand, having talked to people from FinCEN, is going to be built from the ground up with fairly new technology, if not the latest technology. And so I think there's a hope that and an expectation that the beneficial ownership secure system, BOSS, or the database is going to be maybe not the latest and greatest technology, but far ahead of whatever anyone has seen with respect to the SAR database. And so it should be a lot more responsive, and hopefully accessing it will be fairly quick.
That's good to hear. That's definitely excellent to hear. I think we'll all keep our fingers crossed as we get until we're actually able to get our own hands on it. We did have a question around BOSS. Let's see, do you need to get permission from every individual inquiry for BOSS, or is it for permission for all existing inquiries once the permission is given? I guess, does that unlock it on a go-forward basis, or is it every single time that an inquiry needs to be made, there needs to be a new consent given?
Right. That's something that has not been determined yet by FinCEN. And so, I did mention that, and I flagged that because because it's certainly interesting that you do it in the beginning, let's say, to develop that risk profile, but certainly later on you may want to do it again for if you get negative news or an alert or whatever else, then there is some expectation. I shouldn't say there's some expectation. There is an expectation and a requirement that the financial institution goes ahead and does additional due diligence or enhanced due diligence, and that may entail going back and looking at the beneficial owners.
Would you mind repeating when a financial institution is not able to access the database?
Well, so I'm sorry. So the financial institution will need the consent of the reporting company. And then once it gets the consent and then sends the appropriate certifications to FinCEN, it will have access to query the database through FinCEN, but then won't have access to search the database. So I'm not sure if that answers your question exactly, but maybe I'm missing something, but you'll let me know.
I will, yes. And please, like I said, we've got a whole lot of questions here. So if there are any, just as a reminder, if there are any that we aren't able to get to today, or if we didn't answer it fully, this is all still developing. So we're definitely trying our best here. Anything that we weren't able to get to, or we didn't fully answer your question for, that's why we're here. That's why Risk Out exists. That's why Constantine and Harris Beach exist as well. So we'll make sure that we follow up with you all individually if you didn't feel like your question was fully answered, so we can help shine as much light here as possible. I also think, Konstantin, correct me if I'm wrong here, but I think that this might be one of those situations where we need to have a part two down the road when we're a little bit closer. I think there's a whole lot still unknown, and to your point earlier, I know you mentioned that there's some talk about is this actually going to come out on January 1? Is it going to get delayed? I think there are lots of those considerations to take into account as well.
Yeah, it certainly seems that we're going to need to have a follow-up program. But I think maybe this just highlights, though, how many variables are at play here. And how many variables are in play, the discrepancies between the new rule and the old rule, and there's going to be a lot of uncertainty going forward.
Now, Konstantin, speaking of timeline, I know this is supposed to take effect on January 1. Let's assume that happens and there's no change on that front. Is the database expected to be available on January 1 as well?
It is, although I could see that there might be a little bit of a lag, let's say up to a month, only because it would. So on January 1, a reporting company that gets incorporated on that date or registered with the Secretary of State would still have 30 days to file with FinCEN. So, I mean, yes, the answer is yes, January 1, but maybe there could be a week or two lag, or maybe up to a month lag.
That makes sense. We had a question that said that they were under the impression that we would have to wait until the final rule was actually released before we would know if FIs would have access to the database. It sounds like that's already been determined. Can you elaborate on that a little bit, Konstantin?
Well, that could change, but at the moment, the way the proposed access rule was written, the financial institutions would not have access or would not have searchable access to the database. I doubt that will change just because of the way that it's a non-public database. And when you think about all of the protections that FinCEN has come up with when it comes to whether it's sharing or within the financial institution or the technology solutions needed to protect the information, I think that's a pretty strong signal from FinCEN that it is not going to let financial institutions have searchable access to the database. And look, this is maybe not answering the question directly, but I think that's where you get into maybe a policy difference when you have a state like New York saying, well, why should this be a non-public database? Shouldn't it just be public?
Yeah, to your point, we had a question or two come in and ask if this is happening in New York, and I think you mentioned that it might be coming down potentially in California as well. What are the odds that a similar legislation is proposed in my state?
Right. I mean, it's pretty high.
Wow.
And of course, it depends on the states. I mean, there's certain states that are a little bit more protective of privacy and things like that. But then there's also other states that believe that certain information, that some transparency or sunshine is a good thing.
Yeah, that totally makes sense. We had a couple of audience members ask, they're looking for a little bit of additional guidance, want to dive in a little bit themselves. Where can they find the guidance around the requirement of FIs to use BOS? Where could they find that guidance themselves?
I mean, right now, the best information is going to be from the proposed rule. And we can certainly, send out a link later for people to take a look at the proposed rule.
Yeah, that'd be great. Maybe, Konstantin, how about we can work to and make sure that's included in the follow-up email. So not only will you all have the recording and the slides for this, but we can also send that out in case you do want to dive a little bit deeper. And I think we've got some confirmation here in our questions saying a part two would be great. We hear you all loud and clear. So I'm sure this won't be the last you hear from us on this topic.
And for what it's worth, the federal banking agencies, if they go forward with what they've done in the past, when the final access rule comes out, it'll come out with guidance on the same day. Now, that doesn't mean that the guidance will answer all the questions, because I think this presentation is telling us that not every single question is going to be answered, but at least some of the questions I think will have been answered.
Yeah, we can at least hope so, for sure. Will financial institutions be forced to only get their beneficial ownership information from the database? Or are they able to continue to get it directly from the customer if that's something the customer is willing to provide themselves?
Well, they can get it from the customer. The idea is that by getting it from the customer, they would then have a check on that information and then be able to confirm that information by sending a query to FinCEN.
That makes sense. And will our examiners and regulators have access to BOS themselves?
They will. They will, but only for the purposes of examination and examination as it pertains to customer due diligence.
Excellent. Excellent. And I know that we talked about some of those criminal and civil penalties that we maybe haven't seen yet, but there's definitely a potential there. Is that the risk for not utilizing the database?
I mean, that is the risk. I think it'd be fair to say that at this point, unintentional reporting or misreporting, meaning something benign, I think may not even get a penalty or may get just a civil penalty. But when you start getting into illegal activity, and if you're using the company to aid and abet or participate in some illegal activity, then that's when you're looking at criminal sanctions. I will also point out that everyone already knows that FinCEN is short-staffed at the moment, so it's not even clear how if you're talking about 25 to 40 million entities, and let's just say that 1% of them has some problems with respect to reporting. So you're talking 2.5 to 4 million entities out there that might need some sort of civil penalty. It's not clear that anyone in the country has the capacity right now to be handling that.
That's a good point.
Whether it's FinCEN or a U.S. Attorney's Office, that would be a high number of cases. I mean, even if you said 1 in 1,000 cases, you'd still be talking 250,000 to 400,000 cases.
That's true. That's true. That's a good point. I know we still have some questions on the table, but we're getting close to time here. So Constantine, I'll ask you one more. Is there an expectation on the part of FinCEN that institutions will need to cure or fix any discrepancies that might be found between the financial institution's beneficial ownership information and FinCEN's BOS registry information once those discrepancies are identified?
Yeah, I mean, look, if they're going to continue to onboard the customer or to keep the customer, if it's an existing one, then there's going to need to be a policy and procedure to move forward and to resolve the discrepancies.
Well, Constantine, I appreciate your time. I know we really filled up all that questions or question time, and we could keep going here if we were able to. So I'm sure that you'll see Constantine again, as well as myself, hopefully on a part 2, especially as we get a little bit closer here. But if you do want to reach out to any of us, we are always able to get in touch and answer any of the questions that maybe we weren't able to fully dive into today, just simply due to the amount of timing that we have here. I do want to say thank you all for taking the time to join us today, and particularly thank you to Constantine joining us from Harris Beach today, sharing all of his time and deep expertise. I know I learned a lot. I hope that you all did as well. As a reminder, go ahead and keep an eye on your inbox. We will go ahead and send out an email tomorrow that does contain not only the recording from today's session, but the slides, any additional handouts. We'll make sure that you have a link to the regulation if you want to do some deeper dives yourself. And we'll make sure that's all in your inbox for your convenience. If you have any additional questions, or if you want to learn more about RiskOut, or if you just want to swing by and say hi, you can come visit us at riskout.com. We hope to see you on our next webinar. Constantine, thank you again.
All right, thank you. It's great working with you.
We'll see you all next time. Bye.